Whether you are a long-time participant in financial markets, such as digital currencies, the stock market, or other financial markets, or you are just entering this field, you must have read or should read John Murphy's book on technical analysis. In this video series, we want to thoroughly discuss John Murphy's technical analysis book together. As I mentioned in the introduction, whether you are new to the digital currency or financial markets, or if you are an experienced participant, you must have read or should read the book on technical analysis. So together we are going to analyze this book. This book is so important that it is known as the Bible of financial markets. And in fact, when it comes to technical analysis, it is probably one of the very first books you should definitely study. Let's see together what it's all about. In the first pages of John Murphy's technical analysis book, he talks about the three main and fundamental assumptions of technical analysis. What are these three main and fundamental assumptions? The first assumption is that the priority is with market behavior. When they say the priority is with market behavior, it means that it doesn't matter why the price has reached a certain level. For example, it doesn't matter why Bitcoin has reached 100,000. The reason isn't important. What matters is that it has reached this price. It's not important why the price corrected and hit 75,000. What matters is that it has now reached 75,000. The reasons behind these price movements are examined more in fundamental analysis than in technical analysis. The second assumption is that history repeats itself, the very idea of history repeating. When we talk about supports, resistances, and trend lines, we're actually discussing narratives that involve the repetition of history. All topics related to technical analysis are, in some way, connected to the repetition of history. The third point is that price moves in trends. When you look at prices in the market, they don't move randomly. They definitely follow a certain trend, which we will discuss in detail later on. Before we continue with the rest of this lesson, I'd appreciate it if you could subscribe to the channel and hit the notification bell so you'll be notified as soon as a new lesson is published. Now, the next topic that Mr. John Murphy discusses is, which one should you use, technical analysis or fundamental analysis? First of all, both types of analysis are important in their own right, but why should technical analysis have a higher priority? That depends on these 3 points. The first point is that technical analysis gives us better entry and exit points. This means that in fundamental analysis, you don't really have clear entry and exit points. You're working with long-term trends. But in technical analysis, you can pinpoint, or at least more accurately identify, entry and exit points. You can see, for example, that the price has reached a suitable high, has hit an order block, and in that order block, you should enter or exit. You can easily find this with technical analysis. The second point is that technical analysis is very flexible. This means that with technical analysis, you can analyze the market on your own, just with a chart at hand without needing a team. Of course, if you have a team, that's even better, but if not, you can do it yourself with your own expertise. But with fundamental analysis, it's not like that. In fundamental analysis, you really need a team made up of people with expertise in economics, politics, culture, and other areas, so they can analyze the market from their own specialized perspectives. Another point is that technical analysis can be done across different time frames. From short term to long term, you can analyze the market in short time frames like 1 minute, 5 minutes, 15 minutes, or 1 hour, to medium term like 4 hours or 1 day, and even long term like weekly, monthly, or yearly. This isn't really the case with fundamental analysis. With fundamental analysis, you mostly look at the market in the medium or long term. But the last topic we want to discuss here is spot or futures. Which one? We need to have a clear understanding of what spot and futures are. If you've worked in financial markets before, you probably know this. We're not going to go into all the details of spot and futures here. We'll just cover what John Murphy mentioned in his book. In the spot market, you buy a currency, a stock, or any other asset. And when you buy it, you own it. For example, if it's a digital currency like Bitcoin, after buying it in the spot market, you can transfer it to your wallet and easily hold it, or later bring it back to an exchange to buy or sell. But in the futures market, you don't own the asset. You can only buy or sell that asset or stock through a digital contract. And beforehand, you have to specify whether you're opening a long or short position. In other words, you have to decide whether you think the market will go up or down. The profit you make depends on what you initially decide. If the market goes up and you said it would go long up, you'll profit. But if you said the market would go down and it actually goes up, you'll lose. So in the futures market, you don't own the asset, but you can profit both from the market going down and from it going up. As we said, you can decide in advance whether the market will go up or down, and if it moves as you predicted, you'll make your profit. But in the spot market, it's not like that at all. You only profit if the value of your asset goes up. If it goes down naturally, you'll lose. Another point is that in the futures market, you can use leverage. This means, for example, if I say the price will go down and it actually does, and I had set a leverage of 3 from the start, I'll make 3 times the profit. For example, if a currency drops 3%, I'll make 9% profit. But the opposite is also true. If the price moves up against your prediction, you'll lose 9%, and that amount will be deducted from your assets. I hope this lesson was useful for you. See you in the next video.